Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the earnings special edition where our focus will be on the tire maker CEAT's Q1 numbers. The revenue for the company has grown by about 10.5% year on year to over 3,529 crores. What we were also given to understand is the profitability has seen a decline of 27% this time on a consolidated basis, where the net profit has come down to 112 odd crore rupees. Here the operational company performance on the EBITDA level has grown by marginal 1.3% to 387 odd crore rupees, even though the margins have declined from 12 odd percent last year same quarter to 11 odd percent now. Now this is being seen as an impact of the higher costs and higher marketing spends that the company is looking and facing at this point in time. But the company has also announced a Capex at this point in time. They are planning a 450 odd crore rupees of a Capex for its Chennai plant. And to detail for us, what have been the pressure points and whereas what is the outlook on the entire fiscal year's performance, I'm now joined by the top management of the company. Mr. Kumar Subbiah joins in. He's the CFO of CEAT. Warm welcome to you, sir. Thank you so much for taking the time out for this conversation. Let's start off by understanding the drop on the profitability figure, sir. Is it only an aberration? Do you see this pain continue in the next quarter as well? And could you detail for us some of the key reasons that you've mentioned?
Good morning, Sakshi. Thank you for having me on your show. Coming back to your question, the gross margin in Q1 of the current year compared to the corresponding quarter of last year has dropped to the extent of about little over 2%, largely on account of the raw material price increase that we witnessed in the last 12 months. Some of those increases we have passed it on in the form of a price increase. The extent of price increase in raw materials that we have not passed on is what is reflected in the form of a drop in gross margin. And in addition to that, in the quarter that went by, we had our IPL. So generally during the IPL quarter, our market associated or connected with IPL slightly goes up in that quarter. So therefore, these are broadly the two reasons for some drop in margins year on year in the quarter that went by versus last year's same quarter.
Okay, sir. So do you expect your marketing spends to come down now since IPL is over, or will there be an elevated level that you're looking at even now?
No, see, since IPL event is over, marketing spend gets normalized. If you really look at it on a full year basis, our overall marketing spend is in the range of about 2.2, 2.3%. Okay, so it goes back to the normal level. So in Q2, I don't think there is any exceptional IPL spend that we would have. In addition to that, we are also expecting raw material prices in Q2 to come down sequentially by about 2% or so over Q1. So therefore, we hope, if our prices remain the same, we should have a positive impact.
Okay. So if the costs come down, sir, what does that do to your pricing strategy going forward in Q2 and thereafter the quarters as well?
No, see, as far as the pricing is concerned, any drop in raw material prices that we see in the current quarter or later, I don't think it would have any adverse impact on pricing, because the entire incidence of increase in raw materials has not been passed on. So therefore, normally it would stay and we would like our gross margins to move up as the raw material prices come down in the future.
Could you give us a guidance, sir? What are you going with for FY26 on the margins front?
No, see, look, if you look at our margin in generally, we are comfortable in the range of about 12.5% plus or minus a percentage in the normal course. And in general, in a good quarter, when the raw material prices remain stable, we would be at the higher end of the margins. In quarters where we are impacted by sudden increase or a spurt in raw material prices, we would be at the lower end of the range. So I think that is the range in which we are currently operating. And in any favorable movement in raw material prices, should help us to move the margins to the mid end or a higher end of the margin range, which we would like to operate.
Okay. And do you expect that improvement on the overall performance of the company to start coming in from Q2, or will it take, will it be deferred by one more quarter, sir?
No, look, in any business performance, there are two important components that we all look at. One is on the revenue side. Okay, we are very happy with the progress that we have been making in the last few quarters or even last 2 or 3 years. Consistently, as top line has been growing. Even in the quarter one, we grew by about 11.5% year on year. Even in quarter four, we had grown in double digits. Overall, in the year FY 24-25, we grew by about 11% or so. So therefore, on the top line
Sure.
side, yeah, we are comfortable in terms of the double-digit growth that we have been targeting and achieving from that side. On the bottom line and margins, considering, in a tire industry, commodity costs play a very
Yes.
important role. So, and as the commodity prices have been fluctuating, mostly uh, moved up in the last 2 years due to various geopolitical events. That is when we try to uh, operate in maybe lower end of the margins, which we normally mitigated through price increases. So in quarter two, we look forward to raw material prices cost going up by about 2%. Okay, and we also look forward to growing our top line in quarter two, like quarter one. So I think with
Okay.
mixed performance, I hope it turns out to be a better quarter.
Fair point. Let's come to the demand scenario, sir. First, help us understand on the OEM demand. What is it panning out to be? We are not seeing, auto space being in the top shape. There are so many issues that are erupting. The recent issue was the rare earth magnets issue that has impacted, the sector as a whole as well. There are supply constraints that the companies are facing. So, help us understand what is the demand scenario on ground. What are your OEM clients telling you about medium to long-term demand now?
Okay, so you have to look at it with two lenses as far as OEM performance is concerned. Uh, as far as the quarter one, on year-on-year basis, very strong growth. Okay, in excess of 20% year-on-year in the OEM segment. Part of it is also because we had a relatively a weak quarter one as far as OEM is concerned in the previous year, and we had voluntarily, lost some lower end passenger car radial business with one of the OEMs, which we came back not in that segment, but a higher end, little higher end tires came. So therefore, that really helped. Overall, we grew very strongly year on year as far as OEM business is concerned. But if you look at really quarter on quarter, okay, it's kind of a flat. Okay, so therefore, quarter one was very similar to quarter four, and so OEMs are impacted on account of various reasons, particularly while rural side of the country is doing better. In the urban side, I think OEMs are losing uh, maybe in terms of growth momentum, which I hope will recover. And EVs is an important part of our own plans. So therefore, as it's going to be the growth engine for OEM business, it's important that we participate in that growth. We have a reasonable share, so going forward, we are able to grow along with OEMs. That side, I think we are sensing some kind of issues in terms of OEM volumes getting impacted in the event that they face issues in sourcing the critical material from China or from other sources. So in general, overall OEM is showing a weakness. From our side, I think we'll be able to sustain, considering that we have got some wins with some other OEMs. So we see it as year on year will continue to grow on OEMs. Quarter on quarter, it is subject to some of these factors I just mentioned.
You mentioned China, so I wanted to understand a little bit on the tire requirements from your clients. How are you looking at the competition surge with Chinese players and the Chinese imports coming in? How are you looking at that, sir?
Okay. No, I mentioned in the context of rare earth, which
Yes,
is an important material for a EV
sure.
OEM point of view. For as far as we are concerned, okay, I think we had explained in the past, tires attract a lower rate of duty when it gets imported from some other countries. It's not necessarily from China, though there is an anti-dumping duty applicable on
Okay.
commercial category of tires. But Chinese companies who have manufacturing base in, say, Southeast Asian countries, such tires do come into India, maybe in the duty range of about 6-7%, whereas most of our raw materials that we import into India attract a very high rate of duty, like rubber at 27.5, and many of them attract even anti-dumping safeguard duty, particularly synthetic rubber, carbon black, etc. However, we are not seeing any movement, significant jump in the import of tires either from China, from other countries at this point in time. So therefore, we are not seeing that as a threat. Post-COVID period, for a period of 2 to 3 years, some of the importers had to obtain license to import tires from the government. But I think and that led to sudden spike in demand from the Indian manufacturers of tires. But I think that has evened out. So we are not seeing that as a threat, import as a threat at this point in time.
Okay, so how is the replacement market doing, sir? What's the demand scenario here panning out to be?
Now, last 5 to 6 quarters, we have been going very strongly in replacement. Okay, we have even last year we grew close to about 10.5, 10.8%. Even in the current quarter, year-on-year basis, we grew on high single-digit numbers. 2/3 of it was volume growth and 1/3 of it was a price growth. So therefore, we have been growing strongly for the last 4 or 5 quarters in the replacement. It was only in the international business that it was flat in quarter 1, year-on-year as well as quarter-on-quarter.
Okay. So let's also a little bit understand on what's happening globally on the tariff policies and the tariff concerns that are coming in. How is the industry really looking at that? If you could also help us understand a little bit on the exposure that you have on the US markets, and is there any significant concern on tariffs front for you also?
Okay, see, our exposure to US is small relative to the size of the organization, say under 5%. But
Okay.
however, it is a market where we have plans. In the past, we have shared our plans to launch truck and bus radial tires in the US, passenger car radial tires in the US. Both of them have happened. We also would like to grow our specialty business off-highway tires in the US. And one of the acquisitions that we are planning also has a reasonable exposure to the US. So US is an important from our standpoint, though our exposure to US is less. Broadly, just to help you and the viewers to understand, US tariff has broadly two categories of tariff that they have introduced. One is called as auto components. Okay, another one is called as non-auto components part of it. Okay, auto components part of it, US government introduced incremental duty of about 25%. Okay, for example, prior to the first week of May, I think around 5th of May or 7th of May, some new duty was introduced on auto components. Prior to that, our tires that we were exporting to US used to attract close to 5%, 4.8% duty. Okay, now from first week of May onwards, auto components where our passenger car, truck and bus and radial tires, light truck tires attract now additional 25% duty effective May. Okay, and the other portion is like, for example, farm tires, some of the off-highway tires, etc., used to attract similar about 4.8 to 5% duty in the past. Now it attracts additional 10% of duty. So in all our trade discussions that India currently, I believe, would cover the scope of the second portion. So for the second portion duty, which is about non-auto components, is based on reciprocal tariff. So if we are able to strike a good deal, that reciprocal tariff, if it comes down, it will have an impact. We also hope the auto components also comes under reciprocal or a part of a trade deal that may bring down the duty rate, incremental duty rate from 25% to a lower level. That will really help. And so that's the way we see the impact of US tariff on.
Okay, below 20% you said, sir?
No, 25% is the incremental. Earlier it was about 4.8%. Currently,
Yeah.
all our tires of truck, passenger car, they attract close to about 30% today, effective first week of May.
Oh, okay. Okay, so we'll have to see how it really pans out. Maybe in the next
Yes,
couple of days, we will have to understand, and maybe we'll invite you again, sir, once the final decision is made to help us a
sure,
little bit more on the
sure,
same.
sure.
Help us understand now on the announcement that you made on the expansion part, sir. As we are given to understand, currently your utilization rate would be about 80%. That is 70 lakh tires per annum capacity. What does this additional, expansion plan do to your capacity plans, and how much will it add approximately, and by when is the expansion expected to be completed, sir?
Okay, so in Chennai, you would know, look, Chennai plant was set up in the year 2020. So it's a 5-year kind of a plant. We started with small with passenger car, certain number of tires, added truck and bus radial. Passenger car radial tire today is currently, we have about little over 20,000 tires per day kind of a capacity. So our utilization level is high. Okay,
Okay.
it's in excess of 80% in the quarter that we went by. What is happening is in the marketplace, we set up this capacity with an assumption that a tire would weigh a certain level. Like for example, we assumed approximately weight of the tire would be about say 9 kgs in case of passenger car radial. As the market is changing more and more to SUVs, higher inch tires, the number of weight of the tire also goes up as the diameter of the tire increases. So from that standpoint, this is more to configure our Chennai plant to produce. Earlier, we had set up a capacity close to about 30,000 tires per day, say 28,500 tires per day in a phased manner. We would like the plant to produce, say, 30,000 tires per day, very close to what we had done, but to equivalent to the average weight, which has undergone a shift in the last 2 years. We expect it to change further as the tires are becoming bigger to take care of that kind of a configuration. So we expect the investment, means since upstream capacities are determined based on tonnage, so this would lead to about 60-70 tons increase in the upstream capacities. So and therefore that investment is going to be made so that we are able to restore the capacity in terms of number of tires. We hope to complete this process in the next 18 months' time.
Okay. Sir, could you help us understand on the funding of this expansion? Is it going to be via internal accruals? And what is the current debt position on your books, sir?
See, look, in general, most of our investments, Capex, we make an assumption that 2/3 we would borrow and 1/3 we would accrue.
Okay.
It will come through internal accruals. Is the assumption that we make to justify the business case or to clear the business case from that point of view. In reality, we generally try to manage it at a higher level of internal accruals and lower debt depending on that. But no, look, in addition to Capex, we have announced acquisition of compact tire business of Camso. So
Yes.
from that standpoint, we also need additional funding. So in the quarter one, look, for example, we spent about 230 crores of Capex. All of that we managed it through internal accruals. And overall, our debt level came down by about 114 crores. So we were around 1,920 crores as of end March. We are about 1,810 crores as of end June. So it's a small drop in debt, little over 100 crores even after incurring the Capex. So we are comfortable at current levels. Our leverage ratios are comfortable, healthy, and we would like to operate within a range. We don't want to overburden the business with a higher level of or excessive level of debts.
Okay.
So today debt EBITDA is about 1.2. I think we are comfortable with it.
Comfortable with the current debt to equity ratio. Okay, sir, help us understand on the new acquisition that you're talking about. What is the kind of peak potential of the revenue contribution that you're expecting from this, and what will be the timeline? Then we will see the entire impact coming onto your books, sir, on the top line.
See, look, when we evaluated the business, okay, and the size of the business revenue was coming to about $150-160 million as a realistic basis based on year 2024 performance and estimate. That is the level at which the revenue is being generated in that category of business by Camso. So our endeavor is to complete the merger, our acquisition related formalities in the current quarter. Earlier our schedule was July. I think there are some regulatory approvals that are work in progress. We hope those approvals would be obtained by the seller in the current quarter, and hopefully from next quarter onwards this revenue should start coming to us. In the initial period, we may still take the help of Michelin in terms of servicing the customers till such time we establish our own infrastructure. So from that standpoint, progressively will come, but the revenue should start coming from coming quarter onwards if you are able to finish this formal acquisition related approvals in the current quarter.
Okay, fair point. Sir, we'll leave you at that. Thank you so much for being with us on the program and detailing for us all the insights on the earnings. I wish you all the best for the upcoming quarters, and I'll see you soon, sir, on the channel yet again for your views. Thank you so much.
Pleasure talking to you. Thank you.
Thank you so much, sir. All right, viewers, you got to hear from the top management of CEAT as to what have been the key factors in case you've been looking at the bottom line and the drop of 27%. That's largely led by the higher marketing expenses and the increasing cost of the commodities and the raw materials that you've seen. Although the expectation is that from Q2 onwards, there should be some ebbing of the commodity prices and the raw material prices, and the expenses will also come down because largely these marketing spends were related to IPL, and that's now done. Of course, the margin outlook is consistent with the company's 12.5% kind of a band that they're looking at this point in time, and they're also comfortable with the debt to equity ratio at this point. And acquisition, as to the timeline that they've given, is that by July end they should be finishing it, so that by the coming quarter we should be seeing some impact of the new acquisition also on the earnings. On the positive side on the revenue front. So that's something that we'll definitely look at as well. More importantly, the management has also highlighted and impact of what could there be on the reciprocal announcement, and everything will also depend on what kind of a deal does US-India really strike, and what is the percentage of the reciprocal tariff and what comes in for the auto sector. That will be extremely important for them to also watch out for. So we'll keep you posted with all of these updates. I hope you enjoyed the conversation as much as I did. Stay tuned on to Business Today Television. We'll continue to get you fascinating insights from the world of markets.
Hello and welcome to India Today. This is Anita Brito in conversation with the one and only Salman Khan. Hi Salman, how are you doing?
I'm good. How are you?
Very, very good. And I loved what you did on